What's up, everybody? Everybody seems a little lethargic after lunch. So fortunately, we have a fire panel here. I'm joined by Alex, Mark, Ben, and Xander, four guys with a lot of experience and perspective in the space. We'll keep this one fun. I think we'll look at sort of institutional adoption, stacking sats at scale. We'll look at family offices, Bitcoin treasury companies, and a bit about the macro environment. I would like to be a little selfish here, and since we have Ben on stage, I would like for you to break down or explain what the MicroStrategy playbook is.
Well, we could cover 30 minutes just on that, but first I want to give a lot of credit to BitcoinDay here today. This was a pretty unique conference. I'd not seen a conference that had the perspectives we got out of like the Gen Z panel. That was new. I hadn't seen that anywhere but here, and that was really enlightening to see that. So well done there. When it comes to institutional adoption and corporate adoption, Strategy is the household name now, right? They're the behemoth in the space, and they've really been the innovators along the way. And it started out with a fundamental idea that Bitcoin on the balance sheet is better than cash on the balance sheet, right? It started that simple. That was the foundation of it. And I think what Saylor saw was that we've got this antiquated financial market out there that's providing products that are on autopilot integrated into people's portfolios that they depend on as they move throughout their lives. As you go through the saving phase into your retirement phase, it changes the way that you need access to your money and the types of products you need. What he also found was there's a lot of institutional investors that have very specific niche investments they need to make. And so the way that this kind of evolved was he started targeting those pockets of capital. The first one that we saw, which was kind of the mainstream product for a long time, was the convertible bonds. He found out there were convertible arbitrageurs out there, and the product they need is volatility. They want bonds that are on top of an equity that moves a lot because they're trading throughout the day, and that's how they capture their gains. As he moved on from there, he found these perpetual preferred equity products, and he realized he could tailor-make products that not only meet institutional demands, but meet retail investor demands. And you're seeing that right now with Stretch. But if you look at the fundamental of what is he trying to do for his shareholders, if you look at the common stock, he takes a Bitcoin-denominated view to his shares. Every action he's taking in the capital markets on a combined basis, he's looking to increase the exposure that each share of common stock and Strategy holds to Bitcoin. So over a long time horizon, if you expect Bitcoin to really succeed in a big way, like I think everybody in this room does, that exposure becomes very powerful. He's also creating an ecosystem that allows traders and long-term investors to participate in the same asset because of the volatility of Bitcoin. But I think the most interesting one that's capturing people's attention at the moment is a product called Stretch. And the reason it's capturing everyone's attention is because it fits a need of the individuals. So what he's offering is effectively a money market style of a product. He's trying to create capital stability where he can peg the product to $100. And he's doing that by, if it goes above $100, he's the one selling shares into the market. But what he can bring to the market that they're not getting out of a money market account or some other account, a savings account, is he can provide higher yields. And he can do that because of the belief in the compound annual growth rate of Bitcoin. You can think of these preferred products as a carry trade. What they're doing is they're raising capital today, deploying it into Bitcoin, and if that compound annual growth rate outpaces the yield that they have to issue to the investors, that excess value that gets accrued goes to the common stock. And so that's the model he's building. He really built the first stock to allow people to get extra exposure to Bitcoin over long time horizons.
Maybe a simple way to break that down on an individual level, would that be sort of I take on credit so that I can get more Bitcoin and pay back the credit and keep the extra Bitcoin? Is that simply what he's doing on sort of an individual level?
What do you mean when you say on an individual level?
I'm using credit to acquire more Bitcoin. I'm going to pay the fiat costs, and it's going to be less than the appreciation on the Bitcoin. And so I want to ask the other three gentlemen, Mark, maybe you can go first. Do you see high net worth individuals, family offices, or institutions looking to adopt the MicroStrategy playbook?
Sure. Today's Saturday. Tomorrow's Sunday. Some of you will go to church tomorrow. Maybe some of you will go tonight. I would encourage all of you, whether you're a person of faith or not, to go to the book of Exodus, chapter 32. The Israelites had just been freed from the slavery and the tyranny of Pharaoh in Egypt. They were liberated to the promised land, and they sat at the foot of Mount Sinai. But they got bored. They didn't like the volatility. They didn't like the price action. And so they traded their liberation. They took off their gold, and they said to Aaron, melt down our gold and create for us a golden calf that we can worship. Bitcoin is the only asset since the beginning of mankind has existed that all of us were able to front-run Wall Street. So the idea that the family office or me as an individual would arbitrate or exchange my liberation for another counterfeit god, to me is absurd. That said, I fully respect and understand the financial engineering that is at play. My primary issue as Stretch is, what is Stretch's source of capital to pay the dividends? It is the direct dilution of MSTR common stock holders who, oh, by the way, have the junior claim in the capital stack to the BTC that MSTR owns. So they're arbitrary. They are. If you have an idea that you should sell Bitcoin or take your fiat and put it into common stock, which you are junior to the preferred, for a reduced claim to the preferred, and you're going to get diluted to pay the preferred dividend, I think that is absolutely insane. So that said, the family office, our allocation is about 10%. It's actually only in Bitcoin, and probably will only ever be in Bitcoin.
Are they looking to borrow, lever into? I'm assuming not then. It's just...
From a strict financial perspective, this is the cold reality of our world. We can get an 85% advance rate on equities, north of 90% advance rate on treasuries at SOFR plus 50, 60 bips. Even if we wanted to use our Bitcoin holdings as collateral, it's far more advantageous to simply borrow against our book of securities at a much higher advance and a much, much lower cost of capital.
That makes sense. Alex, how would you describe 2025 and sort of, right now we're probably 8,000 down year over year, but only 100 days ago we had all-time highs, and Bitcoin has been sideways for a year, and primarily the biggest year of Bitcoin treasury companies. So what do you see as sort of the narrative coming out of 2025?
Yeah, so that's a great question, and I think 2025 is like welcome to Bitcoin, really. Bitcoin typically goes sideways to down most of the time. If you look at any given year in Bitcoin, there's something like 10 to 15 days each year that the vast majority of the gains, something like 80+% of the gains occur in those 10 to 15 days. Aside from that, it's pretty much a slog. And as you're waiting, that can be super, super painful. If you've not been around for a really long time, if you bought near the all-time high of 126K, it's probably real painful for you. I can remember back in, I think it was 2021, that we hit that 69K top, and then the following spring and summer, it went all the way down to 16K. How many were here for that ride? Okay, so like a third of the room. Everybody else is like, oh my gosh, what's happening? Hey, get used to it. This is the way it is, right? So I think it was completely normal, but in those terms. But aside from that, I think structurally, I think what happened in 2025 was actually really, really important, because during that period of time, we're basically chopping sideways somewhere between, let's call it like, I don't know, 85K, 90K, up to 126K, somewhere in this range. This is a much, much higher range where a tremendous amount of Bitcoin turned over, changed hands. We saw a lot of liquidity. And some people are like, oh my gosh, this is horrible. Look at all these OGs they're selling and they're cashing out. Have they lost faith in Bitcoin? Is this like really bad? The thing is that there's two sides to everything, right? There's also a bid there. Who the heck is buying all of that Bitcoin? That is the more interesting point to me. It's not that the OGs were selling. If you think of it like this, the first 8 years of Bitcoin's existence, we mined something like 15.75 million, if my numbers are correct, of the total supply. That's a huge amount of Bitcoin, all at a price point, either buying it or mining it, sub 1,000 cost basis. At 100K, that's a 100x. And people are like, well, why would the OGs sell it? Have they completely lost faith? We're like, they got 100x. Wouldn't you maybe sell some of it and like live the life you want to live? So I don't begrudge those people for doing that at all. In fact, it's absolutely necessary to sort of reset the entire ecosystem in the current price range, which is foundational to go to the next 10x. So I would say just chill and wait because it's coming.
Maybe to speak to what's coming, Xander, what have you seen institutionally in this space besides maybe just adoption of buying Bitcoin?
Yeah, so the big driver, especially as we zoom out, I love this the touch point on everyone getting all excited about a price drop from 120 plus down to where we're sitting right now, stagnant 95. I think 6 years ago everyone was oh, we're going to break 60, we're going to get to 70. So I totally agree with the zoom out and just keep DCAing and holding. On the macro side and what we're saying, so by way of background, I help run a company that focuses on infrastructure for large institutions. So we do wallets, we do institutional grade custody. And this year, obviously regulation has been a massive driver for institutional adoption. And that's the broad spectrum, but specifically as it relates to the Bitcoin ecosystem, for one, we have companies now coming onto the table that 5 years ago I used to beg to try to get a dream of a conversation with. I mean, think about tier one banks, think about IBMs of the world, these large scale institutions, and the distribution that they have. For instance, we signed a deal with IBM where they fully white labeled our infrastructure and they created their entire own digital asset infrastructure product called Digital Asset Haven, which means every single IBM customer in the world, whether it's a financial institution, whether it's a government, all has access now natively within either their on-prem environment and their HSMs or their cloud environment as well. Then they can have access to this Bitcoin wallet. All they have to do is flip it on. So these are things that we're starting to see more and more of, not only at the tier one banks that are all looking now into buy, sell, hold use cases, and then all the additional, I always call it like orange pilling for the institutions, where it's going to start with the craze of, okay, we want interoperability for stablecoin or whatever it might be, and then it's all kind of piggybacking into this vertical of like, we know that Bitcoin not only is a treasury asset, but also as the utility function, whether that's global payments for remittance or other use cases, these are starting to come up more and more and more. So it's a very exciting time, and I think 2025 was an unbelievable inflection point for institutional adoption of the asset class entirely. And everything we're seeing now, whether it's European guidelines with MiCA or everything that's happening with the Genius Act here in the US and Latin America, they're all replicating a lot of the MiCA standard. We're seeing this just rapid increase in the adoption cycle at scale, and that's all backed to start with the infrastructure to be able to support it, whether that's how governance is concerned in terms of internal policies or signatures, and that ownership of that actual underlying key structure. So yeah, I think it's going to be a very, very exciting 2026.
Well, speaking of 2026, maybe Ben, why would Bitcoiners, or why should they be excited about Bitcoin treasury companies, maybe even versus ETFs? Let's say they have already Bitcoin. Are they excited about it because maybe non-Bitcoiners are going to be interested in these products, or should they be excited about it because they can use these things in their own lives?
Yeah, certainly. And I think one of the big things that came out over the last year when treasury companies emerged is people thought that treasuries are a replacement of Bitcoin. I think that that's what they really thought that the ethos was people were telling you, don't buy Bitcoin, buy treasury companies. And that's just not the case. Like even in my own personal life, right, Bitcoin's always going to be the foundation, right? If it works for a corporation, if it works for a country, it's going to work for me as an individual. So the foundation should always be Bitcoin. What treasury companies are going to offer are different flavors of exposure and access from different types of investors. And I think in 2026, you're going to see a lot of scaling start to happen, right? The first year, I would say it was more about people just emerging into the market and giving the markets kind of a master class in what finance looks like. He brought up a conversation about capital structure. You were never hearing conversations about capital structure from retail investors, probably until this year, I would say. I mean, what Saylor's been building really does put a highlight to what a capital structure for a corporation looks like. Most people would never know. But what I think you're seeing this year is the pivot, and you are starting to see the emergence of the digital credit products coming into the market, and I think those are really transformational. When you look at the age of a lot of the investors out there in the market, you have this massive swath of people that are starting to reach retirement and move more towards the fixed income portion of their portfolio. And if you look at things like the traditional draws you'd put on a portfolio in retirement, they tell you 4 to 5%, and then you'll be set forever. If you're able to blend in products, you might just see that a stretch offers 11% or a SAID offers 12 and a quarter. If those products blend in and raise the average that you're generating out of the fixed income, that's a massive change to people's lives. And if you can do it while managing the volatility, which is what scares a lot of people away from Bitcoin, you can make a real difference in that capital still onboarding into the Bitcoin network, which I think is very important. Something I look at and I've thought about a lot is when you get somebody like Satoshi who creates something like Bitcoin and then walks away and you give Bitcoin as a gift to the world, nobody in here as an individual gets to tell everybody else how to use that gift, right? It was a gift. And we're going to see building on top of this. And what I want to see is Bitcoin intertwined into the fabric of our financial markets, of our capital markets, because I think the more structurally important and the more you can facilitate that transition off of fiat rails and onto Bitcoin, the more unassailable the asset's going to become. So I see this evolution as being very important. What I also see are companies that are likely major players in the future. You ask yourself, there's a lot of discussion about companies that have put Bitcoin on the balance sheet. Are they trading at a premium? Are they trading at a discount? The first thing is they put Bitcoin on the balance sheet. Massive step. If it's right for you as an individual to hold Bitcoin as your core capital asset and as your money, it's the right idea for businesses. I think what a lot of people want to see is traditional businesses that they're used to also coming and putting it on there. But I see the structured finance component of this as being massive. And I think you'll see more large players. You've got Metaplanet, who's starting to step into this in Japan, who's going to help bring new yield-type products to the Japanese markets, which have been starved for yield forever. I just think that we're going to see an evolution that probably none of us expected. And the companies that are capitalizing themselves on Bitcoin today, if you look 10 years down the road, 20 years down the road, if you have even a moderate belief in what Bitcoin's going to do and how important it's going to be, having a balance sheet full of capital is never going to be the wrong answer. Because I don't know what the world looks like in 10 years. I don't know what the world looks like in 20 years. But I know having the soundest capital on earth is the right choice.
The world's obviously changing very quickly, and we're getting all sorts of new terminology, Bitcoin yield per share, different things like that. So, Mark, I have to ask you, is digital credit a gift and or a curse?
That's a good question. This is how I probably would choose to answer that question. If you go back 100 years, 1929, 1970, 83, 88, 96, 2000, 2008. Those are all cataclysmic events in the traditional financial system. Great Depression, Volcker shock, S&L crisis, etc. Every single one of those events only had one thing in common. They were all credit events, leverage and credit. And so the idea that somehow we can build a future of Bitcoin involving credit, I think is dangerous. What I also think is, again, in the family office environment, we're thinking in terms of generations, like probably all of you are as well. What will stand the test of myself and my kids and my grandkids? And I know two things. Number one, if Bitcoin, when Bitcoin becomes the most important asset financially in the world, and if there are publicly traded companies that primarily own that, and that's their sole business, people will say, well, they'll be the biggest company in the world, and they will clap their hands for that. What they don't think about is that if that's true, those companies will then become GSIFs. That's an acronym, GSIF, Globally Systemic Important Financial Institutions. And what does that mean? Those only exist within a highly regulated regulatory perimeter, right? So again, we've now ceded our liberation, we've ceded our fiat that we could put into personal, individual, sovereign, perpetual, forever, individually held, self-custodized property. And now we're in a GSIF in the perimeter of the SEC, the OCC, the FDIC, the CFTC, and that, as we think long-term generationally, is not a good trade.
So, Alex, do you think the DATs and the Bitcoin ETFs and these things are evidence that Bitcoin is eating Wall Street, or is Wall Street eating Bitcoin?
Okay, so that's an interesting question, but I'm going to answer it perhaps in a different way than you're thinking. Mark, I'm going to say that you are obviously a very sovereign-minded individual, right? We have this massive regulatory environment. It's probably going to keep continuing unless it, for some reason, doesn't continue. So, irregardless of how all this pans out, whether we add more Bitcoin to that system or not, that system will probably continue unless it doesn't continue. I think the only way it doesn't continue is if enough people get to the point where they're shunting massive amounts of economic energy into a system that doesn't continue to feed that system. Okay, so I guess my point with that is that to me it doesn't matter one way or another because that system will continue to exist. I think that we're talking about scaling Bitcoin. Earlier today there was a panel where Gary Cardone was saying that like the rest of the world doesn't necessarily see Bitcoin the way some of us from the early days of Bitcoin see Bitcoin. The first couple of generations of people that came to Bitcoin, you had the cypherpunks originally, and then you have like what I call the sovereign finance individuals that came to Bitcoin. I think that's most of the cohort here. For the rest of the world, they don't get that. Like there's a very small percentage of the human population that actually thinks that way. Right? So I'm of the belief that as ambassadors for Bitcoin, we have to start meeting people where they are and understanding where they're coming from and understand that there is the reason that all of these different financial products exist, the credit products, the derivatives, they exist because there is a wide spectrum of investors and they all have different needs. A sovereign investor is going to have certain kinds of needs. An individual is going to have certain kinds of needs. A family office is going to have certain kinds of needs. An institution with fiduciaries is going to have very, very different needs, right? So, and then you have central banks and you have all the other things, right? So I don't think the derivative thing is going to go away. Derivatives have been with us for a really long time. Our entire system is constructed of derivatives, essentially. The US dollar, what is a derivative? Let's talk basic stuff. A derivative means that something is derived from something else. Orange juice is derived from an orange. You might say an orange is the underlying base asset, right? And orange juice is the derivative, is one way to look at it. US dollar is a derivative of gold. Nowadays, it's based on trust, but like you're starting to see all of these things happening where stable coins is like the big deal. It's what they're all arguing about as far as for the Genius Act and the banks are arguing against allowing interest and all this. And you're starting to see all these competing things. You've got certain families that have their own coins that they're issuing. You have all this stuff going on. And across the spectrum, you see all these institutions that used to laugh at Bitcoin. The IMF used to laugh at Bitcoin. The central banks used to laugh at this. And now they're all deeply investigating it, right? And they're at the point now where they're looking at it and going, okay, this is not going away. And it's continuing to gain traction, right? The IMF first started laughing at it. They're like, ha, 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 you Bitcoin people. And they're like, well, it's only for criminals. Only criminals use Bitcoin, right? And now they're like, we're making our own. Or this, I'm talking about like the European Union, right? The CBDC thing. So they're not on board with Bitcoin, but they're at the point where they realize it's not going away and they better get with the program somehow. So this is what I call the climbing Mount Stupid phase. Lots of people who get exposed to Bitcoin go through this phase. They find Bitcoin, they're like, this is really interesting. I want to get in on this action. I'm going to make my own coin. I'm going to make my own stable coin, make my own this, make my own that. And you're seeing it happen at the nation level now. They're all climbing Mount Stupid. You know what they're all going to figure out eventually is? There's only one that has no issuer. There's only one that is truly neutral. There's only one that can't be gamed by some other person controlling a centralized system. So my view is that if you look 20, 30, 50 years out, I think Bitcoin is going to become the de facto base layer, pristine collateral asset for the digital financial system, which will be composed of tons of derivatives. And whoever owns Bitcoin today, my opinion, may sound crazy, but I think you guys are going to be the Rockefellers and the JP Morgans of the future.
Obviously not financial advice, but Mark, like, when you said your family office has 10% allocated to Bitcoin, how do they think about the other 90%?
Yeah, I mean, this might be an unpopular opinion, but there are opportunities for alpha outside of Bitcoin. Please hold your booze and just talk to me after. Once you get to a certain level, you have to think about a lot of issues: tax, liquidity, income, custody, trusts, generations, offshore, onshore, slats, grats. We are with one of the largest traditional wealth private banks in the world. Every year they publish a family office allocation report, and it shows us within it's Citi. I'll just say it's Citi. So globally, Citi family offices are at 0 allocation, 0. So we're at 10. So I take solace in that. However, we still believe that what makes America great outside of Bitcoin is the capitalistic nature of our financial system, which is built upon the laws of reaping and sowing, right? The liquidity event that created the family office was a blue-collar background and a private equity exit. So it was a blue-collar, work your butt off, generate a product, create profit, pay people, pay out to shareholders. And that's one of my largest issues just theologically with the DAT. Because in theory, the primary business model, the primary service or product is dilution of common equity holders. And I don't think that over time, using the law of reaping and sowing, if your primary model is selling your own stock to pay the preferreds to go buy more Bitcoin in the name of something called MNAV, BTC per share. Like, I remember when it was like not crypto, Bitcoin. Now it's not crypto, not Bitcoin, DATs. Like, when did that happen? So if your primary business model product is dilute the common to pay the preferreds, to acquire Bitcoin, to pump the MNAV, BTC yield, PTC per share narrative, which is a psyop for return on equity, we do not believe that that is an investment that we want to make, and we're not going to allocate a dime to that. To go back to your question, again, there are other options outside of Bitcoin, but I've gone way over my time, and I apologize.
Do you think maybe Strategy's approach of never selling Bitcoin and capturing profits from the trade, if they were to sell a small amount of Bitcoin to show that they're capturing profits from the carry trade that they're performing, would that change your point of view?
I don't want to just take over this. I'll just say this: every week when my Twitter says X company, no offense, X company has acquired 13,000 Bitcoin, and Bitcoin Twitter erupts and claps. Oh, that's 13,000 Bitcoin that my kids will never be able to individually, sovereignly hold as personal, decentralized property. I weep when a corporation whose only model is to sell equity and dilute common shareholders, that they took 13 Bitcoin out of circulation forever. However, if a company that generates profits, who has a legit product or service, chooses to allocate their capital to Bitcoin, I am definitely much less averse to that idea. So if Tesla or other companies want to sell Bitcoin to fund a CapEx project, c'est la vie.
Let's switch to gold.
I think Xander's actually due for a question.
Well, Xander,
this is not my panel.
Xander, what do you see maybe coming through in 2026 for institutional adoption?
Well, first I want to go back to, what did you call it? Mount Stupid?
Climbing Mount Stupid.
Yeah, I'm going to use that for sure. That's amazing. So again, like going back, and again, don't mean to be too high level with a lot of this commentary from my side. Another key area that, if you think about regional finance in this country, which represents roughly more than half of the United States citizens in this country belong to a credit union. Right now, 5% of their monthly deposits are leaving, and they're going to things like, the Coinbases of the world, where they can have access to these digital assets at large. So now what's happening is we're seeing a rush from regional finance in this country to adopt infrastructure to be able to support and then keep their deposits within their own environment. So there's a lot of, I would say, levers that are being pulled, and a lot of people don't even see a lot of this. I mean, how many people in this room have heard what I said about IBM earlier? Has anyone even heard this news? Yeah, so these are things that are happening at the infrastructure level that I think 2026 is really going to bring to the forefront. Just so you guys know, 75% of every single financial transaction that happens crosses an IBM mainframe at some point, whether it's the initiation, the throughput, or by the very end. So just by that and these activations, we're seeing more adoption from, think of companies like some of the largest consulting agencies or technology infrastructure companies, traditional, that are now adopting digital asset strategies, because not only is it something that they're saying, okay, there's a business here, but it's also recognizing the fact that this market changed in 365 days due to the regulatory environment. So it's now what I mentioned earlier. I've been in the Bitcoin space building infrastructure for a long time. These companies, they're not doing it by the sense of, okay, we're now orange pilled and we're ready to necessarily jump all the way in, but they're doing it from a business centric side first. And climbing Mount Stupid is a really great way to say this, because sure, they're gonna mess around, they're gonna do stablecoin initiatives, they'll probably do some altcoins and everything like that. But I think all roads inevitably lead to where is the actual asset class, or the asset in particular, that can be that financial instrument that the hope of gold once was. So Bitcoin, again, there's a finite, it's a very simple supply-demand economic structure where there's a fixed supply, and all of this is momentum up as it's just a demand-driven price target. So it'll be interesting to see not only how the institutional adoption continues to grow broadly, but also how that starts to get realized more into the price, because right now the price is not reflecting anything that's actually happening on the institutional infrastructure side. And then the debate between DATs and treasury companies, I think that's a very prevalent debate within Bitcoin right now. But we'll start to see these instruments, I'm sure, continue, and then we'll also see, to your earlier point, I think the companies that are adding into the balance sheet in a way that benefits their entire market cap, and also strategically for maybe it's just to have a timeless balance sheet. I think we'll see inevitably more of that. And say what you want about DATs, I think what Michael Saylor has done is open the eyes of the institutional world in a way that it's a humongous advantage, not only for everybody that's been early in Bitcoin as price will continue to appreciate, but also from the perspective of institutions are now at the table, and it takes massive movers at one point, like a Michael Saylor, who has done he's moved miles for not only the adoption of Bitcoin globally, but also bringing Bitcoin into a legitimized TradFi world, which I know sounds a little contradictory, as we live in a very this room, Bitcoin is very decentralized, but it will continue to be Bitcoin. If you want to buy Bitcoin, it's still the best way to buy Bitcoin is buy Bitcoin. It's not going to be buy a derivative of it, in my opinion.
Mark, maybe we'll have some fun with this. If you were running a Bitcoin treasury company, what would be your vision? Let's say we handed you strategy today as is.
Michael Saylor's a genius. There's no doubt about it. I mean, he is. What he's been able to do financially, I would agree. No human being on earth over the last 5 years has done more for Bitcoin than him. Full stop, all respect, tip of the cap, 100%, 100%. But as someone who spends, I'm in the family office world, right? We're looking at opportunities. Opportunities are problem solvers, they're products or services that meet a need in the marketplace, that have a functional business model, whose model is to generate profits and distribute profits to shareholders through toil, reaping, and sowing. So if I was a CEO, if I said, hey, let's turn into a DAT, I'd say, okay, how will we actually be able to differentiate ourselves besides who has the coolest preferred, who can do a put option call spread and kind of generate yield that way? How can we have an actual business, a cash flowing business that redistributes, repurposes, reallocates investor capital, EBITDA, net income, whatever you want to call it, into Bitcoin? I haven't given that any thought because I've never actually thought about doing that, your question. But I think if there is going to be a 2.0 of what we have with DATs, the answer probably should be a cash flowing business that figures out how to take all that that generated capital, all of that return, and poured into Bitcoin, but again, meets an actual need in the marketplace.
I don't know, we definitely have maybe 5 minutes for Q&A if anybody has any questions.
Should Bitcoin treasury companies and ETFs and other public entities that hold Bitcoin publish their addresses so we can all verify how much they have?
Yes.
I can take it as one of the companies. So far we haven't, and it largely follows the logic that Strategy's had at the moment, where when you're operating as a fiduciary to shareholders, no matter how infantilely small the possibility is, what you don't want to do is open yourself up to a direct honeypot and have people focus on your individual addresses. Now, in Bitcoin, there's a lot of the addresses that get discovered anyways, right? Anyone who's ever been out on an Arkham or anything, people are clever, they're finding these addresses, they're publishing them regardless. But, Saylor said before, they'll do proof of reserves when they can do it with like a zero proof where they don't have to put the actual address out there. You've got a divide around that at the moment, and I think all of us are looking at that because with the ethos of Bitcoin, you would like to be able to do that proof of reserves and just have it be transparent and stay with the transparency of Bitcoin. I think that's a great outcome. This is all very new at the corporate level, right, to the point, which is why there becomes so much passion both for and against it, right? This is completely new that's out there. We're all treading through this territory. I think you'll start to see it trend that way over time, is the honest answer. I think in the early days, you're using these qualified custodians, you're making sure you're mitigating your risk. Part of the issue with how you have to do custody as a corporation is you have to be able to put risk controls in place to make sure that no individuals within the organization can take an action on their own that could adversely affect your shareholders. So we'll see this evolve, and I think that there's going to be people that create solutions along with this that make that a reality and make it very easy for everybody to do that.
Yeah, I'll add to that. I completely agree, especially sharing, like you said, all the addresses already been, you can just see, like, someone says they're going to buy 13 million Bitcoin, you could usually track where it is. 13,000 Bitcoin, sorry. The other side of the way to do proof of reserves as well is to look at the custodian. So in these omnibus models, which means the custodian is pooling together all the Bitcoin that they hold for all of their customers, it's not of a very clear understanding. If you have a segregated wallet and you're at this custodian, that's one way to do it at a high level, where even just by saying, okay, our custodian, at the custodian level, we have a segregated wallet, we can verify that. But I totally agree. There's also something called dusting. So if a publicly traded company lists their public address and everybody in this room is like, let's send them some love. They then have to go report that and figure out how to send that money, what to do with that money. That's now a regulatory issue. So the proof of reserves thing, I think, we're seeing it with a lot of, like, the Texas bill, there's a proof of reserves. I think the way that's going to have to happen is going to be it's going to come from the regulatory side, and then there'll be, safeguards to, I think, everything that you're mentioning.
Yeah, dusting was always very interesting because all of a sudden you start seeing these mini micro donations showing up in your wallets. And, but yeah, what they're doing is throwing little dust into there, and they're trying to track that wallet as it starts to move. So it happens, every time a new wallet gets spun up.
Ben, I don't know if you guys have discussed this at Strive or you have any thoughts on strategy, but would any of these companies start a Bitcoin trading desk, like Goldman Sachs style, and start to commander and see a lot more of the flow and sort of maximize and monetize the deal flow that way?
It's possible over time. I mean, I still think we're just so early in this journey that for the companies that have gotten out of the gate now, you're looking for what is the biggest opportunity in front of you. And you're trying to evolve ways for people who might not natively find Bitcoin on their own to still get some of the benefits of what Bitcoin provides. And so for us right now, like, we do see the credit market, and I know Mark thinks differently about this, we see that as a massive opportunity where you can bring the value of Bitcoin to individuals in their real life through the dividends that are coming out there, and that can make a material difference, and it's a massive, massive market, right? There's one thing you can ignore, which is that credit is a huge, huge market. So much capital, trillions and trillions of dollars. And so we see that right now as being the big opportunity that we should hyper-focus on, because we think you can bring a huge benefit to common individuals' lives, people who might not be able to take that step and take on the volatility of Bitcoin. To Mark's point about dilution, right? Dilution became this word that comes up now with these companies because, yes, you are issuing shares at a premium, you're capturing a spread, you're raising the book value underneath each of those shares. Where we probably differ is I view both the common equity and the preferred equities as products. You don't realize how much of the financial markets run on volatility. If you go to Wall Street and you go to any one of those shops down there, what they're looking for is the best asset to provide them their returns that they need to achieve. Bitcoin was incredibly unique in that manner, right? This was a very volatile asset. It moved a lot, but you didn't really have the vehicles that gave them the ability to trade constantly and to be able to make those profits and outperform their peers. This is massive in the hedge fund space. And now you're starting to see that. So what I have with my common equity is because, we're effectively amplified or levered long to Bitcoin, however you want to phrase it, our equity is actually more volatile than Bitcoin. Same thing strategies was. It was more volatile than Bitcoin, which accelerates their ability to meet their mandates. So I agree with Mark's utopia of I would love for Bitcoin to have become this complete grassroots where it's all individuals taking over the money on a short time frame. But I think there's also a reality that we have a world and a structure out there that needs to be onboarded, needs to be transitioned. And I'm not going to look at that reality and stay away from it. I see a way to bring capital into the Bitcoin network, and we can disagree on the way that that is done, right? And I think you will see the cash flowing businesses coming out that have the Bitcoin balance sheets. And when we see a lot of that, we should applaud like heck, because Bitcoin belongs on every balance sheet. You don't have to be a DAT to have Bitcoin on the balance sheet. I think it belongs on every corporate balance sheet that exists. And so we're going to see the evolution happen. For now, we're focused on our lane. We believe digital credit to be a very transformative product. We can bring yields out to the market that most people can't because of the power of Bitcoin, because of where we are on that adoption curve. But you're going to see 1,000 different models for how people integrate Bitcoin into their businesses and the types of businesses that they create with it.
Okay, guys, I got one more question out here, and then we gotta go and move to the next panel. So,
okay, I had too many questions, but I guess it's going to be more of a comment than a question at this point because you guys went into so many topics. A couple of points. I do believe that credit is going to be $1 trillion market on corporate level and individual level. Look, even we just saw the digital natives, right? Like they're going to be, transacting in digital money, crypto, and for example, I even worked on a project like credit history, right? You can't just look at the fiat part of the system and discount the digital assets part of the system. And just going back to Saylor, I think many people, I think Mike is fantastic. I think he's the monster marketing machine for Bitcoin. Having said that, I think the truth is in the middle, and I think the issue, it's not the what and the how. And I do believe that, Bitcoin and digital assets belong to a balance sheet, but every company has, different risk appetite and liquidity and all of those things. But in addition to that, I think the issue is the proof of reserves, that there is a way of doing it, but because of what happened on Wall Street, many companies lost trust with audit firms. Like we heard so many issues when they're doing audits and those. I mean, I work for all Big Four, so I was there. I know how it's done. But I do believe that regulation is going to